inflation, we've had this really complicated macro situation where we had supply chain shocks, which was people can get factories and ships sorted out because people were still in lockdown with COVID. There was a massive backlog of orders, and this filtered through, and that raised prices because everyone, if there's a shortage of goods, if you pay more, you get the goods, right? So that puts prices up. Then we start to see issues in the commodity sector that have underinvested. So everybody comes online again, everybody wants oil, gas, everything else. So commodity prices start exploding. Then we add on a Russia-Ukraine war and the penalties on Russia, and that takes a bunch of commodities out of the market. So now we're in this perfect storm of prices rising. But people are also scrambling, like all of us, probably you guys as well, to try and hire people. So we're all bidding up wages. But wages, outside of some jobs, aren't rising as much as prices. So what we've got is this situation where wages have gone up, let's say 4.5%, and prices have risen 8.5%. So everyone's taken a 4.5% or 4% haircut in their net worth. Now that hit crypto. It started as soon as inflation happened, because if you think of crypto as a groundswell movement, basically the dollar cost averaging by average people who are in the space had started drying up. Been in this sideways sloppy range because we've seen no network growth across the entire ecosystem. Within crypto, we'll talk about that later, but so that slowed down there, but we still had that kind of after effects of stimulus, people coming online, so economies were growing, but it now looks like all the forward-looking indicators are starting to roll over and starting to show recession, because you've basically given everybody a income haircut. So discretionary spending is going down the toilet. We're seeing it in things like restaurant spend. We've seen consumer credit going up, so people are desperately trying to borrow money to maintain their expenditure plans. We've seen mortgages go up by the most in history as a percentage. They've absolutely exploded higher. We've seen 2-year interest rates with the largest 1-year rate of change in all recorded history. We've seen, so what we've got, if you add all of these things, and we've seen the US dollar going up fast, when you put these things together, what you've got is the fastest tightening of monetary conditions in history. And we've seen it, the big tech companies are all starting to lay off staff. They're all like, holy shit, even Amazon said we're overstaffed. So we've completely turned the economy from, oh great, we're coming out of recession from the pandemic, to, oh my God, we're going straight back into recession. It's like 2018. But 2018, the S&P was down 22%, it's only down about 15, 16 now. So I think there's more pain to come before the Fed suddenly realise that growth's gone. And the bond market will tell us that first. It always does. Yields will start falling, and that will be probably the signal, as we had in 2018, crypto stabilises, the growth end of equity starts stabilising because they realise that some stimulus is coming. If inflation is still high-ish, because it's going to take a while to come down, but I think it comes down pretty fast, but let's say it's still at 5%, and the economy is now headed directly into recession, what do the Fed do? Well, they're unlikely to purely stimulate, because optically that doesn't look right. So my guess is they'll do what Europe's starting to do and Japan's starting to do, which is direct transfer payments that I've been talking about for a while, which is basically MMT. So i.e. you give money to the people who need it to cover the costs of their bills going up, and you basically finance it by buying bonds. The best example I've got of this, a lot of people go back to the 1970s and say that it's this all over again, but the 1970s was very different because it was driven by demographics as well. You had all of the baby boomers coming into the workforce all at the same time, and they bid up prices. This is actually more similar to coming out of World War II. So World War II, economic activity had shut down except for the war effort. It comes on, World War II finishes, we start the Great Rebuilding. What happens is that prices exploded. Economic growth plunged, and then prices went negative. Economic growth ends up stabilising. Bond yields stayed stable between 1% and 3% for the next decade and a half. Economic growth was very strong because of technology and stimulus. And that feels like a similar situation. We've got this massive rebuild of infrastructure. Supply chains need to come back to locally, so they have to build factories in the United States. Okay, they're robots, not going to hire people, but it's good for the economy. We've got this massive tech revolution going on, so we've got economic growth to come, I think, with relatively low inflation. But you're right, this is the equal and opposite effect of what we've just seen, which was the sharpest, fastest slowdown in history. We've now got the sharpest, fastest rise in history, and that will probably get unwound as well. So it's like dropping a rubber ball off the top of a building. Each one of these will get less, but I think we've got a few more of these cycles to get through. So the world is the most indebted it's ever been as a percentage of world GDP. The US is the most indebted country as a percentage of world GDP of any country in all economic history. All of that is against the collateral. So you borrow money against something. So you borrow money against your shareholdings, you borrow money against bonds, you borrow money against your house. So if you allow the price of those assets to fall too far, your debt gets liquidated. And we can't allow that because it's too big. I mean, these are hundreds of percent of GDP. So you basically could destroy everything. So that's why we need to be super careful. That's why the central banks panic and buy things like, if you look at the in the pandemic, they started buying mortgage bonds and they bought corporate debt. It's because if you allow that stuff to go bust, the whole system's blown up. That's nearly what happened in 2008. So they can't allow it, which is why we're in this weird mess where they keep debasing the currency, because that's the only answer they've got, which is one of the reasons that we all own crypto. I think the oil market needs to break, because that's the headline inflation thing that real rates have been following, and it feels like it's starting to happen now, but it needs to break a bit lower. And then, you know, if the oil market comes down to $70 or so, that's going to ease a lot of people's fears, because this Russian fear is in everybody's minds, the oil market. So if that happens, I think that happens first. The dollar is helping bring down inflation. The next part is the bond market will tell us. It always does. The bond market, much like 2018, there was that final panic in 2018, in December 2018, where the equity market puked. We had higher inflation, the dollar was going up, then the oil market broke, and then finally yields started rallying, and that was the signal that the Fed were going to pivot. The dollar is a game of musical chairs. It is a world massively in debt in dollar terms. Most trade is done in dollars. So most borrowings are done in dollars. In fact, most of the world's lending is done by the euro-dollar market, which is the offshore dollar lending markets, generally driven by the European banks, the Japanese banks, and some of the Asian banks. It's a game of musical chairs because the moment that growth slows down or growth is too fast, generally it's when growth slows down. When growth slows down, people need dollar financing. And there's less dollars in the system. If the Fed are withdrawing liquidity right now, there's less dollars, so you're taking a few chairs away. First one was Sri Lanka. They're like, where's my chair? Gone. Right? And you'll see one country after another. We're now seeing China starting to devalue its currency. It's because part of their chair's been taken away. One of the chairs has been taken out of the room. So that's what happens, is there's too much dollar borrowings, and in a slowdown, people need more debt, and there's not enough debt being given out because the Fed are taking supply out of the market. In the other side, the dollar goes up. The dollar's got a smile. So if the world is growing, generally the US has been the kind of leading world economy in terms of where you want to put your capital. So in a growing world, the dollar tends to do pretty well. The dollar does very well in a slow world. The dollar does terribly in a kind of muddle through reasonable growth world. These technologies like AI, electric vehicles, green energy, space, robotics, genetic sciences. You don't put the genie back in the bottle just because you raised interest rates. The technology keeps moving forwards. So what happens is they actually get cheaper over time if they're trading even sideways. So much the same as crypto, you need to put them into a nice logarithmic channel. And things like Amazon have been in a perfect log channel since it launched. And it sometimes gets 2 standard deviations oversold and maybe 3 standard deviations oversold. And that's usually the sign that you've had a capitulation, unless the network is failing. So Netflix right now, we're questioning, is Netflix a network or is it just a broadcaster? But is Amazon going to fail here? Literally zero chance. So what we're saying is, because of inflation, these stocks are going to get cheap. Because of the interest rate backlog, they're getting cheap. But the ongoing adoption of technology is relentless. So therefore, they're getting cheaper every day. So we should be looking at entries exactly the same we do with crypto. We look at these markets, and if you've got spare money, then you want to be buying this kind of stuff and not selling this stuff, because it's the same adoption model. This network adoption models everywhere. And if you stack all of these things on top of each other, all of these technologies, and there's a whole bunch of these things, including crypto, what you've got is a whole bunch of Metcalfe's laws piled on top of each other, which is what's called Reed's law. And it's the fastest pace of change the human race, I think, will ever go through. I mean, it's an extraordinary period of time, and you don't want to get knocked off that game because of what's the volatility in markets. You know, these things are inherently volatile. These logarithmic channels and network adoption models are volatile, but you can't get knocked off your game for this because you're missing the big picture, which is why it's so important not to use leverage in these network adoption models. It's a mess. You've seen what's going on with the Terra ecosystem as well. I mean, they're actively selling Bitcoin. You know, I hear, Jump in that whole equation is selling Ethereum. We've got, it's just liquidation of everything. And it's interesting because it's spilling out into the macro world as well, obviously. It's like stuff like oil, which was like the last thing that was holding up the inflation narrative, is starting to get properly clocked. Everybody, I think, in every position is about to lose money. It was what I was hoping to see, which is that the more mature the network gets, the less volatile the price becomes. So I was expecting, and yet to be proven out, that each time we go through a bear market, that we see lower percentage falls. So Amazon is, I use this as my best example of network adoption models. It came out of, it went public, it fell 96% in 2001. It then rallied back, it fell 65%, then it fell like 45%, and then the sell-offs were 30%, and then was even less. So that's because the network gets more mature as more and more people join it, so it becomes less volatile. So that should be true of Bitcoin and should be true of Ethereum. And I think that's playing out. So what ordinarily would have been maybe at this point down 70% has now been in a sloppy down 50% sideways range. Okay, that's a whole new thing we haven't seen before. So it's interesting. Now, it's yet to be proven out. Who knows what plays out. I look at the chart of Ethereum and I'm like, this could be a head and shoulders top, in which case we go significantly lower. We go back down to 1500. Who knows? Or what's more likely is, I think, is we're forming another sort of wedge, and that therefore 2000 is the low. I just, I don't know. These are volatile assets. But that the early adopted, so Solana should be what Ethereum was in the last cycle. How much was Ethereum down in the last cycle?
95%.
Well, it's going to be somewhere around that, right? And we've seen that play out, that kind of, Ethereum's been slightly different because it had so much adoption in this cycle. But generally speaking, they kind of look like each other at early stages, like the Amazon. So the early ones look like Amazon, and they become less like Amazon they become less volatile over time. So Bitcoin and ETH seem very similar these days in that kind of volatility structure. But, Solana, Terra, all of this needs to be proven out. But, it's very difficult when markets like this, when everything looks absolutely terrible, it's very easy to extrapolate the worst. But generally speaking, it feels that it's going to be shallower and shorter, because I don't think it's driven by the halving cycle any longer. I think this is driven by the macro. This is a pure macro event. And I think as Ethereum has become a more dominant ecosystem over this cycle, its own kind of triple halving, or whatever you want to call the ETH2 merge, is going to be another factor within this market. So I think the structure of the markets changes, and that's just the network maturity that we talked about before. It's just how things evolve over time. So I think the structure has changed. I think it's going to be shorter because we think the macro cycle is shorter. I think we all kind of agree that feels like that's where we are. So it's short and brutal, but it's not been as brutal as the past ones, because the past ones were crushing bear markets. Don't forget, this time in 2018, we talked about 2018 a lot in this chat, is at that stage, 2018, we were down huge. I can't remember what we were down in Bitcoin